If you earn $80,000 a year as a self-employed person and you have the wrong retirement account, you could be leaving $15,000 in tax deductions on the table every single year. A SEPIRA and a solo 401k both look similar on the surface. They are not the same. The difference between them at certain income levels is not marginal. It is the difference between a $15,000 deduction and a $46,000 deduction. This is the comparison no one walks you through properly. Both accounts shelter your money from income tax, and both are available to self-employed individuals with no full-time employees. The SEPIRA, Simplified Employee Pension, has been the default for decades because it is simple to open and has no annual filing requirement. You contribute, you deduct, you invest. The solo 401k arrived in 2001, and the IRS has expanded its rules significantly since. Most freelancers still default to the SEPIRA out of habit, not because it is actually better for their situation. The fundamental difference comes down to how contributions are calculated. With a SEPIRA, you contribute as the employer only, up to 25% of your net self-employment income, capped at $69,000 for 2024. With a solo 401k, you contribute as both employer and employee. That employee contribution, up to $23,000 in 2024, or $30,500 if you are 50 or older, is where the solo 401k creates a significant advantage at lower income levels. This distinction is the entire argument. Here is the maths on $60,000 of net self-employment income. After the self-employment tax deduction, your net for retirement contribution purposes is roughly $56,470. A SEPIRA allows 25% of that, approximately $14,117. A solo 401k allows that same $14,117 as the employer contribution, plus up to $23,000 as the employee elective deferral. Total solo 401k contribution at $60,000 income, $37,117. The SEPIRA maxes out at $14,117. That is a $23,000 gap in deductions from a single account decision. At higher income levels, the gap narrows and eventually disappears. Around $230,000 of net self-employment income, the SEPIRA's 25% contribution approaches the $69,000 annual cap. At that level, a solo 401k with full employer and employee contributions also approaches the same $69,000 ceiling. Above roughly $232,000, both accounts hit the same contribution limit. Below that threshold, which covers the majority of self-employed earners, the solo 401k wins on contribution room, often by a substantial margin. The SEPIRA has one clear administrative advantage. There is no annual IRS filing as long as the account holds under $250,000. The solo 401k requires you to file Form 5500EZ once the account balance exceeds $250,000. That filing is not complex, but it exists. The solo 401k also allows Roth contributions, money contributed after tax that grows and withdraws tax-free, while the SEPIRA does not. If you expect your tax rate to rise in retirement, the Roth option inside a solo 401k has compounding value. The SEPIRA simply cannot match. Contribution deadlines matter. SEP-IRA contributions for 2024 can be made as late as your tax filing deadline, including extensions October 15, 2025 for most sole proprietors. That flexibility is genuinely useful if you do not know your final profit figure until spring. The solo 401k must be established by December 31 of the tax year. You can still fund it up to the filing deadline, but the account must exist before year-end. If you are reading this after January 1st and did not open one last year, the SEPIRA is your only option for that prior tax year. The solo 401k also offers one feature entirely unavailable in SEPIRA loans. Under IRS rules, you may borrow up to 50% of your vested account balance or $50,000, whichever is less. This is not free money. The loan must be repaid with interest, typically within 5 years, but it gives self-employed individuals access to capital without triggering a taxable distribution. For a business owner managing cash flow, this is a meaningful tool. The SEPIRA has no equivalent provision. Withdrawals trigger tax and penalty. The practical decision tree is straightforward. If your net self-employment income is under $230,000 and you want to maximize your tax deduction, open a solo 401k before December 31st. If you have already missed that deadline or you employ staff other than a spouse, the SEPIRA is your vehicle. If income is highly variable from year to year, the SEPIRA's flexible contribution timeline is a genuine advantage. If you want the Roth option or the loan feature, the solo 401k is structurally superior at virtually every income level below the cap. The SEPIRA is not a bad account. It is simply the wrong account for most self-employed earners under $230,000 who open it by default without running the numbers. A solo 401k at $60,000 of income can shelter $23,000 more per year from federal income tax. Over a decade, compounded and untaxed, that difference is substantial. If you want to understand how to pay yourself properly once your business is structured correctly, our video on LLC versus S-Corp, the exact profit level where switching saves you money, covers the exact rules. Choosing the right account is step 1. Choosing the right entity to house your income is what determines how much you can pay into it. If this helped you decide LLC versus S-Corp, the exact profit level, where switching saves you money goes further, it is on this channel.